Hello everyone, welcome to the 24th episode of me learning how to trade using Forex. So in the last episode we went through the technical indicators intermediate course on the official forex.com, and we're currently doing we're starting the advanced risk management course on forex.com. So yeah, let's get started. So first lesson, scaling in and out of trades. So this is called Advanced Risk Management, and date is 24/01/2024. Right, advanced risk management. Instead of entering and exiting entire positions in one go, many traders use scaling to manage their risk. So instead of entering, exiting positions in one go, many traders use scaling to manage their risk. You can achieve this in two ways: scaling to positions and scaling out of them. Achieved in two ways: scaling into positions and scaling out of them. So what is scaling in? Scaling in is a method of opening trades that involves starting with a small total exposure and adding to it gradually over time. So scaling in. Start with a opening trades, starting with a small total exposure and gradually adding to it over time. Doing this can reduce your risk, because if you get your entry wrong and your trade fails early, you won't lose as much capital. This reduces risks, as if you get your entry wrong and your trade fails early, you won't lose as much capital. How to scale in trades. To scale in, you select 2 or more entry levels for a trade instead of 1. To scale in, you select 2 or more entry levels for a trade instead of 1. To scale in, select 2 or more entry points rather than 1. What has happened there? Rather than 1. You open your position at the first entry level with a small total size, then adds to it at each subsequent one. Oh, so adds more money to it with each entry level. So you open your position at the first entry level with a small total size, then add to it each subsequent one, then add to it at each subsequent one. This is particularly useful if, say, you have identified 2 possible entry points. One that offers a high return but comes with more risk, and one a safer option with lower potential profits. So particularly useful if you have identified 2 possible entry points. have identified two possible entry points. One which offers i.e. no e.g. one that offers a high return but greater risk, and one that offers a low return but safer. So in here, open a small position, add to it as trend develops, add to it again once support is broken. So that's the first position, that's the second position. By scaling, you don't have to choose between the two. You can open your position when you think a trade is... by scaling it, you don't have to choose between the two. You can open your position when you think a trend is just beginning to form, and then add capital as a trader earns profits. When doing this, there are three general guidelines to follow. So, three guidelines to follow. Plan your entries beforehand. Plan your entries. You'll need to ensure that you define your entry point targets ahead of time. Don't just randomly decide to add more to a winning trade. Identify key areas of support or resistance that signal contribution if they are broken. Continuation if they're broken. So these could be where, like, I was gonna say like where reversal happens, but you don't. Would it be wise to put it there? Because my thinking is that actually you won't even know when points of reversal comes, would you? Or would you? Because I thought that if you put it in reversal, then you can tell whether to actually do add more capital into it or not. Because if it's going as the way you planned it to be, then you can add more. But if it isn't, then don't add more. So anyways, plan your entries beforehand. So ensure you define entry targets ahead of time. Ensure entry targets are defined ahead of time. Don't just randomly decide to add more to a winning trade. Don't just randomly more to a winning trade. Identify key areas of support and resistance that signal continuation if they're broken. What's your risk and reward? As you add capital to a position, your risk will increase because you will risk losing more money. So the market will be further from your stop. The market will be further from your stop and closer to your profit level. Market will be further from your stop and closer to your profit level. To see how this works in practice, let's take a look at an example trade on the Ep24. So, entry 1, buying 1 CFD. Open 6,500, stop 6,650. Profit target 6,800. Risk versus reward 50 to 100. Because you open at 6700, you stop at 6650, so 6700 minus 6650, that's 50, which is your risk. So you're risking of losing 50 in trying to get 6,800 minus 6,700, which is 100, to get 100. Total risk versus reward, 1 to 2. Entry 2, adding 1 CFD. So open at 6,740. Stop 6650, same stop. Profit target, same profit target. But now you got a, I guess, lower risk versus reward. Yep, lower risk versus reward. So this bit here, but you're risking more to get less. Entry 3, adding another CFD. So this one is 270 to 180, so you just carry on risking more to get less, basically. So yeah, as you can see, each subsequent new position has a drastically worse ratio of risk to reward. However, it's easy to remedy this. All you have to do is move your stop loss. So that was, I think, in the previous one of the lessons, there was like dynamic managing or something, where you can like, was it actively managing or something? You can like actively move your stop loss, so it follows as you profit more. So what's your risk versus reward? As you add capital to a position, your risk will increase. Market will be further from your stop and closer to your profit level. To see how this works in practice, let's take a look at the example trade on the FTSE 100. Right, let's do that. As you can see, each subsequent new position has drastically worse ratio to risk rewards. Each subsequent new position will has a worse risk to reward ratio. However, it's easy to remedy this. All you have to do is move your stop loss. To remedy this, move stop loss. So entry 1, we entered here. Stop here. Stop loss is here. Blah blah blah. Entry 2, move stop loss up here. Blah blah blah. Entry 3, move stop loss up here. Profit targets here. Yep. Move your stop loss to control risk. So if we move our stop loss each time we increase exposure, then total risk can be kept in check. Total risk can be kept in check if stop loss is moved every time we increase exposure. Entry 1. Risk versus reward. Take total risk reward 1 to 2. Total risk versus reward 1 to 2.6. 1 to 2 to 6. I don't get how they got 1 to 2 to 6. Do they just add up? So that would be 60, 160. Was the 1 to 3, so this will be 60 to 180, which is 1 to 3. Oh, they should add it up. Right, okay. Total 1 to 3 compared to the beginning 1 to 2. So you're risking £1 for every £2. You're risking this one. So you're risking £1 for every £3. So by moving our stop loss, we lowered the overall risk on the trade. So we can see the stop moved from 6650 to 6730. So by moving our stop loss, we lowered overall risk on the trade whilst increasing potential return, and along the way we locked in some profits for good measure. Right, okay. Benefits of scaling in. There are three main benefits to scaling in. Firstly, it means that you don't have to worry too much about getting your entry 100% right, correct every time. Don't have to worry about getting entries right 100% of the time. It also enables you to target higher profits without taking on too much additional risk. Allows you to target higher profits without taking in too much risk. As long as you do it correctly as outlined above. As long as it's being done correctly. And finally, by scaling in, you can reduce your exposure and risk less on each trade. So reduce your exposure and lose less on each trade, or risk less on each new trade. Risk less on each new trade. This opens up a strategy of taking multiple new positions, then building on the successful ones and closing off the losers. Some traders refer to as pyramiding into a trade, and it can be a highly effective strategy in strongly trending markets. As well as increasing diversification, such a strategy is a useful way of exploring new ideas without losing too much capital if they don't come off. Useful way to explore new ideas without losing too much capital if they don't succeed. Drawbacks. However, scaling in isn't foolproof without losing. For instance, for one thing, you will need to ensure that you don't end up risking too much from position by your final entry. Right. So how many? Two. Scaling in. Ensure you don't end up risking too much on a position by a final entry. Ensure you don't end up risking too much on a position by your final entry. For instance, if you're allocating 3% of your trading balance to each trade, then don't scale in beyond that point. Plan out entries beforehand, for example by setting 3 entries and adding 1% of your balance at each point to ensure you keep your risk in check. Scaling in can also be tricky for short-term traders. Day traders and scalpers tend to look for small profit horizons, not the strongly trending markets required. day short term day traders. What is scaling out? So scaling out. Scaling out is the opposite of scaling. It's a method that you can use to close positions gradually instead of with a single trade. Instead of a single trade. By partially closing position early, you can realize some profits without exiting it entirely. By booking in some profits as the trade moves in your favor, you can alleviate the psychological stress of trying to exit trades at the perfect level. Ah. Which lessens the psychological stress of trying the perfect point or the perfect level. How to scale out of trades. To scale out of a trade, you close a portion of it without exiting the position entirely. How much you close is up to you. To scale out, close a portion of the trade without exiting the position entirely. How much you close is up to you. For example, say that you have a long position on 100 Apple CFDs, that is 5,000 in profit. You're worried that Apple stock may be in for reversal before it hits your profit target, so you sell 50 CFDs, realizing a 2,500 return in the process. Apple share price continues to rise. You earn further profits from remaining 50 CFDs, while I'm still worried about impending bear run, so you sell a further 25. This locks in more profits before you eventually close position entirely by selling the remaining 25 contracts. So you do it bit by bit to get bit by bit profits instead of having it all in one go. Right, like scaling, this works best if you adjust your stop loss at the same time. By moving your stop up closer to the current price of the market, you can further reduce potential losses and may even be able to create a risk-free trade, especially if you're using guaranteed stops. Works if adjusting the stop loss at the same time. Stop loss up closer to the market. It's average. Not average, current price at the time. Especially if you're using guaranteed stops. Of course, if you had kept all 100 CFDs throughout, then your final profit would have been larger. However, you would have also taken on more risk. True. Tip Don't scale out of losing trades. If your position is in red and you're considering partially closing it, then it's probably a better idea to just close it entirely. Yep. Because then this way you're just dragging it out, so you're losing more money. Don't scale out of losing trades. If you're considering, just close it entirely rather than partially closing it. Scaling out after your target. In our example above, partially closed a position early to lower our overall risk on a trade. We partially closed the position early to lower our overall risk on a trade. That works well, but isn't the only reason for scaling out. If you have a position that has hit your profit target, but where you suspect an extra return could be possible, you could scale out as a method of running profits. Essentially, all you do is close most of your position, but leave the portion of it open to capture any possible continuation. If your original move peters out, you can close the rest of your positions to keep the profits. You may want to consider placing a stop loss at or near your original profit target. That way you shouldn't lose anything from scaling out. Right, okay, so if you have a position that hit profit target, where you suspect an extra return is possible, you can scale out as a method of running profits. You can scale out as a method of running profits. Essentially, all you do is close most of your position. Close most of your position, but leave a portion of it open to capture any profits. If your original move peters out, you can close the rest of your position to keep the profits. If your original move peters out, you can close the rest of your position to keep the profits. You may want to consider placing a stop loss at or near your profit target, your original profit target. That way you shouldn't lose anything from scaling out. Cool. Alright, how to handle news with an open trade. Learning how to deal with the news events is a key part of trading successfully. In this lesson, we're going to cover 4 steps to follow to mitigate risk from the news, plus a few useful steps. At some point in your trading journey, it's likely that some of your open positions are going to see volatility from the headlines. Whether it's an explosive NFP release, sudden interest rate increase, or natural disaster, every trader has to deal with the news event at some point. With a little bit of preparation though, you can ensure that you aren't caught unawares when the unexpected strikes. Follow these 4 steps to ensure you can handle the news of your open trades. 4 steps to handle news. In open trades. Plan ahead. Being prepared is crucial to handling news. Often the events that cause the most volatility, such as interest rate changes and economic data, are scheduled well ahead of time. So making sure you're aware of all the fundamental factors surrounding your chosen market can help you give you a head start. Often the events that cause the most volatility are scheduled well ahead of time. So make sure you're aware. Of all the fundamental factors surrounding your chosen market can give you a head start. Yep. Buy the rumours, sell the news. Remember that the markets will usually price in any expectations about an upcoming event ahead of time. Remember that the markets will usually price in any expectation about an upcoming event ahead of time. If a poor NFP figure is expected to hurt the US dollar, for instance, then it has probably already been priced into USD JPY, so there isn't much point in waiting for it to land before closing your position. However, that doesn't mean that economic announcements can't surprise traders. If data comes in below or above expectations, volatility will often follow. Say that the poor NFP figure is even worse than expected, the USD JPY can fall even further. On the other hand, if it's bad but not as bad as anticipated, USD JPY could rise. So we'll usually price in any expectations. Price in expectations about an upcoming event ahead of time. So there isn't much point in waiting for it to land before closing your position. So there isn't much point waiting for it to land before closing your position. However, that doesn't mean the economic announcements can't surprise traders. Okay, consulting your trading plan. Consult your trading plan. But what about these headlines that appear entirely out of nowhere and send market haywires? You may not be able to trade in advance of these, but you can still plan ahead. Include a strategy for dealing with unexpected news as part of your trading plan. So, include a strategy for with unexpected news as part of your trading plan. The more prepared you are ahead of time, the less stressful things will be if entirely unexpected volatility does hit. A knee-jerk reaction of closing all your positions as closely as possible might only add to the damage. You will be trading at an absolute peak of volatility when prices are gaping and slippage can occur. Instead, you should consider instead of closing all your positions as quickly as possible, consider partially closing your positions to reduce your exposure to the market, opening a hedging trade to mitigate your risk, tightening your overall risk management, tightening your overall doing nothing if you believe that the volatility is only temporary. Nothing if However, don't be afraid to exit positions if it's the best plan of action. Taking a small hit now is preferable to a large loss down the line. That's the best plan of action. Recalculate your risk-reward ratio. Major news events can override all the factors that lead you to open your trade, so it's worth reevaluating your risk versus reward on any open positions from this moment. Re-evaluate risk versus reward ratio on any open positions on the release major event news. For example, you might have a trade that is 90% of the way towards its profit target, but unless you've been actively managing position, that means that could be extremely far from its stop. Take a second to reconsider whether your position is offering enough rewards. Take a second to reconsider whether your positions offer enough reward to justify their current risk. As we cover above, you don't have to close them instantly if they don't. So think about whether your positions offer enough reward to justify the current risk. Consider moving your stop. If you do decide to keep positions open, then the best way of adjusting your risk against reward is to move your stop loss. However, you'll need to be careful about where to move it. The underlying market will be undergoing heightened volatility at the moment, so taking your stop too close to its current price may see your trade close early. However, be careful where to move it, as the underlying market is undergoing high volatility. So taking your stop loss too close to its current price may see your trade closed early. Instead, giving the position a little bit of wiggle room can help in the long run. Give it a bit more wiggle room to help. Just make sure to include that wiggle room when calculating your risk for the trade. Ensure the wiggle room is included when calculating your risk for that trade. If you're unsure about anything, then consider getting out of the trade now. After all, there will be infinite more opportunities to place trades that won't see a surprise news announcement whilst they're open. If you're unsure about anything, then consider getting out of the trade now. After all, there will be infinite more opportunities to place trades that won't see a surprise news announcement whilst they're open. Tips: don't just follow the herd. Tips. Sometimes market sentiment can take over after news events, sending prices skyrocketing or plummeting. If you get taken in too much by these moves, then you could end up buying at a market's peak or selling at its low. When volatility is high, it pays to stick to your plan. Take over. If you get taken, swept along, could end up buying the markets. Slow. When volatility is high, stick to your plan. Take a wider view. The markets don't always react to headlines in the way you might expect. Poor earnings performance could see as stock prices grow, and rising interest rates can make a currency fall. Financial prices are moved by a huge number of interrelated factors, which can be hard to understand at first. If you don't understand the reason behind a major price move at first, do some research to try and learn for the next time. It might give you an edge down the line. True. Don't always react to headlines in the way you might expect. Prices are affected by a huge number of factors. If you don't understand the reasoning behind a major price move, do research until you understand. Stick to your guns. A news event is a good time to re-evaluate your open positions, but it doesn't invalidate them entirely. So if you believe that the opportunity you originally found is still there, then don't abandon it just because of some negative headlines. A reversal formed after some news events can even be a chance to add to your position. Buying at the more favourable price before the market resumes its original trend. Oops, but it doesn't validate entirely. You is still there. Don't abandon it because of some negative headlines. A reversal formed after some news can even be a chance to add to your position. Buying at the more favourable price before the market returns to its original trend. Okay, so save that. So I'm gonna end this episode here. In the next video, we're gonna be going through the correlations and risk management. So thank you guys for watching, and yeah, see you in the next video. Peace out.